Good morning and welcome to Gregory & Gray's webinar, How to Get to Gold. My name is Rich Felto. I'm a partner here at Gregory & Gray in the McDonald's practice group. We're very pleased to have so many McDonald's owner-operators from around the country with us today. We appreciate all of you for taking the time for this important presentation. I guarantee you will learn more than you expect today. Before we begin, I'd like to give you a little bit of background about Gregory & Gray and our long relationship with McDonald's franchisees. We've been working with McDonald's owner-operators for over 50 years, and we've developed a very specialized and dedicated McDonald's practice group. We provide all the services you'd normally expect from a CPA firm, like including accounting and tax, but we go well beyond that for our McDonald's clients to include all the financial analysis, reporting, and business planning that is specific to McDonald's. As a result, we've become one of the leaders in accounting services with McDonald's franchisees across the country, working with numerous owner-operators on everything from financial viability planning to rebuild and reinvestment strategy to personal financial planning. McDonald's is a vital core to our business, and we have become just as vital as a trusted advisor to our clients. If you have any questions about Gregory & Gray and our services, I hope you will call me after today's webinar. I'd be happy to speak with you. Now on to today's topic, how to get to gold. We've been working with many of our clients on this very important topic, and I look forward to sharing our insight with all of you today. So let's jump right in. One technical point before we begin: if you have a question during the presentation, please press the raise your hand button on your screen. We'll get to the question either right away or a little later in the presentation, whichever is most appropriate. So without further ado, let's begin discussing how you can get to gold. First and foremost, it's important to understand the following things: ratios and financial viability. Every month when your financial statements are transmitted to McDonald's Corporation, you can log on to FFS and pull up your ratios. It's important to understand where you are with relationship to those ratios and the importance of the financial viability that's tied to those ratios. You should understand how any business transaction that occurs in your business can positively or negatively affect those ratios. And then once we cover those two topics, we'll then dive into G&A, draw, and debt service, and how to focus on areas of opportunity and the ability to plan for those. And then we'll talk about maximizing profitability in your P&Ls, and then ultimately how to forecast a projection for the future and then to plan for it. The 6-point system. By now all of you know that McDonald's has a new point system in place for your financial viability. An organization must achieve a 6 to be able to be eligible for growth in new term, with 10 being the ultimate gold standard. How do you get there? That's what we're going to learn today. These are the metrics that make up your financial ratios. Each category has a point value assigned to it, and where you fall into those categories, you have a different point value assigned to it. So in order to be a gold standard, you need to be at the top of each of these categories, each of these ratios. The first ratio, which is the most popular, so to speak, is your cash flow coverage. There's a lot of factors that go into cash flow coverage: your pre-debt cash flow, your G&A, your draw and your distributions, and your debt. So there are positive increases and then there are negative decreases. So you need to understand what effect each of these areas will have on your cash flow coverage. Working capital. Basically, your working capital is now projected over, it's judged now over 12 months versus in the past it was a 1-month snapshot. So in the past, when you had your business review and you were low on your working capital, you could inject some cash and you would be able to improve your working capital right away. Now it's a trailing 12-month ratio, so it's important to maintain positive working capital throughout the entire year. It's important to understand what increases your working capital and what decreases. Increasing cash and current assets will do that. Decreasing liabilities will positively increase your working capital. And conversely, the opposite will negatively decrease working capital. Organizational equity. Your organizational equity basically is one of the ratios where if you fall below 25%, you get negative points, and if you're in between 20, 25, and 70, you get 1 point, and over 70, you get 2 points. Most organizations will fall in between 25 and 70, and it's important to know how this calculation, how this ratio is calculated, and a little further in the presentation I'll explain that. So the key to this entire presentation is knowing where you stand right now and knowing how to identify the sensitivity to get to where you want to be. So this slide here is your ratio spreadsheet from FFS. So as soon as your financial statements are transmitted to McDonald's Corporation monthly, you can go on and pull up this ratio spreadsheet. Basically, it gives you your 3 areas of ratios. Cash flow coverage right here in the middle, and this owner-operator in this example has a 1.25. And so what this owner-operator needs to do is figure out how to get from 1.25 to 1.4. The 1.4 is the gold standard for that ratio. Conversely, if you look up top, estimated net equity is at 1%. This organization needs to be over 70% to get the 2 points needed in that category. And down below is your trailing 12-month liability turnover. That is the number of days it takes of sales for the following month to pay the previous month's bills. And what's great about this spreadsheet is it's Excel based. So when you pull this up, you can actually go in and change your pre-debt cash flow to see what the sensitivity is to get from a 1.25 to a 1.4. And that way there you can identify how much money you need to get to the 1.4, which is the key to getting to gold. This next slide is a breakdown of your equity calculation. So this is the example of this owner-operator. Basically what happens is, for purposes of your equity calculation for your ratios, McDonald's uses a cash flow multiple of 4.5. They take your pre-debt cash flow, they back out a factor for G&A, and then they take what's left over, multiply it by 4.5, and they come up with an estimated value. Now, that's not the real value of your restaurants. It would take, a CPA or a trusted advisor to go through a number of different factors to come up with a real value. This is just for the calculation of the ratio. So, and you see in this example, this owner-operator has 41% equity, which lands him in the 1 point category. This is your trailing 12-month balance sheet, where you see in the bottom right-hand corner is the 4.4, which I'll go back 2 slides right now. You see down here in the bottom, 4.4 comes from that trailing 12-month balance sheet. So this spreadsheet basically is a 12-month snapshot of your balance sheets. And if you see down below, it takes your working capital, it divides it by the average daily sales, and gives you a monthly number, which then is averaged over 12 months. So it's not as easy to adjust your working capital as it used to be. So this now more than ever makes you have to be aware of your working capital for the entire year. So now that we've covered understanding your ratios and where you are, and understanding how that ties to your financial viability, and how you can identify the sensitivity to get to gold. Now we can dive into each category to make us aware of opportunities in each area. So G&A. How do I identify opportunities in your G&A? So basically, what you do is you look at each line item and you have to really think if there's any fat that you can trim out of this area. Office rent, for example. Do you have a big office? Can you downsize the office? Can the office run out of your home? That's an area. Your travel and your vehicle expenses, these are areas that sometimes can be excessive. And so, for example, with vehicles, if you have supervisors that drive cars and if you have a director of operation that drives a car and you drive a car, maybe we've had owner-operators go to dealerships in their area and negotiate a fleet price so that every time they go and they get a vehicle from that dealership, they get a reduced price. That's just a small example. And then outsourcing. Operators sometimes can save money if they have a bookkeeper on staff and they're paying that bookkeeper anywhere from $40,000 to $50,000 plus benefits. It might make sense to outsource the back office and have your CPA firm pay your bills. This is a very easy way to save some money. And also, you get extra benefits from that with having your financial statements done quicker. And there's a note down the bottom here. Basically, McDonald's Corporation for the longest time has used $35,000 per restaurant for G&A. As you saw in the equity example I gave you, that's the number they use to back off. We've seen over the last few years an uptick in that number, probably in the area of $50,000 to $60,000 per restaurant now. A lot of that has to do with, time spent on ACA and so on and so forth. So if you're in that area, you're pretty much on target. Now we get to draw. Very sensitive area for owner-operators, and we understand that. So that's why it's very important to constantly plan for income taxes. We have ongoing tax conversations with our clients with the increased taxes over the last few years. With the Bush tax cuts expiring, we also have depreciation that comes and goes, and as it stands right now, it's gone. You can only you can't Section 179 as much as you used to. So this all takes planning to maximize your tax savings. It is crucial to stay on top of that. And then one specific example I can give to help with working capital as well is spread your tax payments equally throughout the entire year. And what I mean by that is you can have a tax account outside of the business where you take an amount of money, 1/12 of your estimated tax liability, pull it out of your business account, put it into your personal tax account, and then pay the quarterlies from there, so that you don't have quarterly spikes in your draw, which takes more time to fall off when you're looking to improve your ratios. So I liken that to spreading like a real estate tax bill over 12 months, like we do on your restaurant P&Ls. That's a good way of minimizing, spikes in draw. And then personal debt. There's a lot of opportunity out there with lower interest rates and mortgage interest rates where you might be able to refinance some personal debt. We've had owner-operators have success with that, so that's an opportunity as well. And then ultimately, when you get down to the number, a budget number that you need to live on, including taxes, then that's your budget that you stick to. There's always going to be, lifestyle, life events that you'll need to plan for, but at least you can budget it and then stick to the budget. Debt. There's always going to be debt with your restaurants. It's a fact of life. System initiatives, rebuilds, MRPs. So with that being said, understand that there are opportunities with interest rates, variable versus fixed, and with new opportunities for debt. So if you're about to do an MRP, take a look at the impact that will have on your financial statements in terms of your debt load will increase, which means that it'll be harder to achieve a 1.2 or a 1.4 based on the additional debt. So what you need to figure out is using a break-even tool, or even a quick example with a contribution margin. Take the additional revenue that you believe the project will bring into your business and multiply that by the contribution margin, and that will give you an estimated amount of new cash flow to go into the organization, and then you can compare that with a new debt service to see if it makes sense. And then lastly, you've got a weighted average option available to you as well. McDonald's allows you to take existing loans and combine them into one loan. There are stipulations involved, and you can find that on Access MCD. The biggest stipulation is the debt cannot be extended beyond 84 months, and but we've had numerous owner-operators take advantage of this and lower their monthly payments overall, which then allows for a number of different things: increased working capital, and then obviously your cash flow coverage can go up because your debt load is lower. And then your relationship with your lender is very important. There are numerous McDonald's lenders that have been in the business for many, many years, and there are also new ones which are, new to the business, but they know what they're doing. And know your lender, know the products that they have, and utilize those products. Now we get to the P&L. This is the third area of your cash flow coverage piece, and the most important, because this is your operations. So there are a couple different reports that you can use that identify opportunities. The first being your norm reports, which compare your restaurant. It's a report that you can get on FFS. These reports compare your restaurant to the top 25 and the top 50% of the restaurants in your region, and it identifies specific line items such as payroll or repairs and maintenance, outside service. So those are the areas that you can focus on with your management team to possibly. And then quintile reports. Quintile reports are also on FFS. The CPAs are not allowed to get those, but we tell our owner-operators to print these reports out, work with them, work with those reports with us, and to identify areas. What these reports are stratification reports, and they identify high-performing factors that influence pre-debt cash flow. Each quintile measures the amount of year-to-date change in cash flow relating to certain factors, such as driving the peak in the fourth day part. Very important tools to compare you to your peers. I'll give you a quick example of opportunities where you might not realize. So in areas of the country where there's snowfall, you have snow contractors that come and they clear your lots, and they plow the snow out, and even in some cases remove snow. So you can actually have your management team sit and do construction bids, or do bids, the bidding process with multiple vendors to see who can offer the best price, but then also maybe to spread the costs over the entire season, versus if you get a a rough January and you've got, $8,000 worth of snow plowing for your organization in January, that's going to hurt your working capital. So maybe you can get your vendor to accept a even amount over the course of the entire snow season, the winter season. Same thing with landscaping. You have your spring cleanup and you have your fall cleanup. Why not, sit down with your landscape contractor and say, why don't I give you X amount of dollars over the entire season, and then we can true up at the end. That way there you're minimizing your working capital risk. And then obviously continue to monitor your pricing, which I know you do. There's companies like RMS, and to make sure that you're comparable to your local market and your co-op. And then most importantly, get your team on board, get your managers on board, have monthly management meetings where you give them specific goals and sit around a table and highlight the successes and incentivize them for achieving rewards. When they have ownership in this, it does work. We've had success with many of our owner-operators that do this. Here's an example of a budget to actual P&L, which we have a number of our owner-operators using. This is a snapshot of 1 month where the budgeted P&L comes across from the original projection. When the month is done, you input your actual numbers, and the variance automatically populates once you input the actual numbers. This is a planning tool to set your goals to be able to get you ultimately to the 10, which is your gold standard. Monitor these monthly and then have your management team adjust accordingly based on the results. So with all that being said, now that we've covered the entire process of understanding the financial viability and the ratios, understanding how certain transactions can, positively or negatively impact those ratios, diving down into the categories of G&A, draw, and debt service, and your store profitability. Now you plan. Now you begin to plan for the future, whether it's a 1-year, 2-year, 3-year plan. I'm going to give you a couple examples of owner-operators that we've seen and helped through tough times. First example is a 6-store owner-operator that when they came to us, they were a 4. Now they're a 7. And they're on their way to a 10. And I'll give you a couple examples of how we helped them do that. They had personal debt, a couple of different mortgages on their home that we looked at, and we were able to get them to a lender that combined those notes and refinance them, and they're saving up to $30,000 a year just in those mortgages. And that basically is a 30% reduction in draw. So that was a huge help. And with their business debt, we took a look at their business debt. We used the McDonald's approved weighted average refinancing. We combined all their debt with and refinanced it into a new loan with a lower interest rate, and they're saving over $100,000 a year in that particular area. So now we're at $130,000 in just 2 areas, just looking at debt. We looked at their financial statements, we looked at their P&Ls, and we looked at the norm reports, and we identified areas in the P&L that they focused on with their management team, and they have found $60,000 that they've made improvements on. So this owner-operator is on their way to success. And in the next example, we have an owner-operator that was even in a worse position. There were 2. And now there are 6. So now they're eligible for growth and rewrite, new term, and they're extremely excited to possibly get to a 10. And we have a plan in place for that. So we saw a quick example of something that is something that I call a life event. So you have owner-operators have children that go through life events, college tuition. If you have a daughter, you could end up paying for a wedding. So these are life events that affect us all. But if you plan for them, then you'll be in a much better position. So this owner-operative had paid for their daughter's tuition for this year through draw, and what we said was, well, there's an opportunity here where you don't have to do that right now because your organization can't handle it. So why not have the daughter take out a student loan for a few years, and then once the organization is financially healthy, then you can pay that loan down. And the owner-operator will do that in subsequent years. And then a specific example with this owner-operator, they had a store manager that was with them for about 25 years, and he was going through a lot of problems, but the performance in the restaurant was so bad, they calculated that the restaurant lost about $75,000 worth of profitability because of this manager, and he was performing so badly. So they didn't really want to let him go, but I told them, I said, you're running a business, and businesses need to make business decisions, not emotional decisions. So they took the emotion out of it. It was a very tough decision to do, but they let the manager go, promoted from within, and now the new manager has a very enthusiastic attitude and has completely gotten that $75,000 back plus some. So that was a great example of an owner-operator taking advantage of a situation. And then they ultimately switched their back office to have us do it, where they were paying a bookkeeper $40,000 plus benefits, so they saved a bunch of money there as well. So, and ultimately they were overdrawing their business, and we put a budget in place based on financials, and they've adhered to that. So this another example of someone sticking to a plan, sitting down to create a plan, and then sticking to it and having success. There are other ways to help you get to gold, and this is another one of those business decisions where it might make sense every now and again to sell a restaurant, where you can take the money that you get after taxes, after paying your income taxes, to reduce some debt service. And what that ultimately may do as well is reduce G&A, because if you have one less restaurant or two less restaurants, maybe you don't need a supervisor, or maybe if that restaurant was kind of outside your patch, you've got less travel to that restaurant, so on and so forth. So by doing so, that helps improve your ratios, and it builds your cash because you're paying less debt, and you put money into the business, and it positions you for growth in the future. And what does the future hold? We all know what the future holds, and it isn't pretty, and we understand that, and that's why we sit and plan with our owner-operators on a monthly basis. You've got minimum wage coming down the pike. You've got health care. You've got new system-wide initiatives, the ongoing required reinvestment, increase income taxes and local income, state and local income taxes. You've got a sluggish sales as well, with projections of probably it's going to be another 12 to 18 months before we can get out of this sluggish sales position. So with all that being said, you need to plan now to be able to get to your 6 if you're not there, and ultimately get to your 10, which is getting to where you want to be, a gold standard. So like I said, you can sit down. You need to create a plan that is realized. It's realistic. It's something that you can actually complete, and it's attainable, and it's not going to happen overnight. It's going to be little steps to get you ultimately to where you need to be. But to sit down and put these into a plan, a 5 to 10-year business plan, which will ultimately get you to where you need to be. But in doing so, you need to maximize your relationships with your CPAs, your lenders, and to be able to help you get there. So back to my first slide. In order to get to gold, you need to understand all these things to one by one to be able to put a plan in place, understand it, and execute it. So just like McDonald's has regions in your divisions, we've got our financial plan to win. So what we do is we sit down with our owner-operators and we help them plan to achieve, sustain, and maximize their financial viability. Okay, so what we do is we put together a business plan and help them execute it. We constantly visit their tax plan, and ultimately we also personally financial plan for them as well, because that's important as well. Timing is everything. Your restaurants have constant reinvestment, so when restaurants have values that peak and begin to decline, you know, it might make sense to understand the equity that you have in each one of your restaurants for the ultimate goal of retirement. So, upcoming webinars that we have. The next one we have is next month, November 19th. It's MRPs, reloads, and rebuilds, which gets into all of the reinvestment and the debt service that goes along with that. And then we'll have a top 10 year-end tax planning seminar, which we'll schedule shortly after the November elections. Two very important, very important webinars to attend. And with that, I'll open it up to questions. And it looks like we have one question, and it is regarding the debt savings on the organization on the second example, where the owner-operator saved over $100,000 in payments. The question is, how is that possible? So I'll dive a little deeper into that. Basically what happened was we took a look at their debt structure for the organization and realized that they were paying a lot of interest, and it didn't make a lot of sense because there was a bunch of different loans. So we talked to their lender and sat down with the lender and the owner-operator and basically put a plan together where we did a weighted average refi, and it worked within the guidelines of McDonald's, and they got a lower interest rate, and they've saved roughly, I think it was $8,500 a month, which is just over $100,000. So that went right back into their cash flow and has helped them attain their goals. And to that point, you know, talk to your lenders regarding your interest rates. You know, on our website we have the lenders' interest rates posted, updated weekly, and there are lenders out there with some pretty good interest rates, and if you see an interest rate on that schedule that is lower than what you're paying, give your bank a call and see if there's something that they can do to get you that you know, that lower rate. We've seen success with that. So with that being said, I will end it. Thank you very much for attending the webinar. I appreciate it, and have yourselves a good day. Thank you.